XLRI presents Gnosis 24/25. Media partner CNBC TV18.
The 15th edition of Gnosis, the annual finance symposium by XLRI, was recently held in Mumbai, bringing together eminent leaders of the finance industry. The keynote address was delivered by Hitendra Dave, CEO of HSBC India.
A well-regulated financial system, fast-growing economy, low and stable inflation. If you're sitting in US, if you're sitting in Europe, if you're sitting in the richer part of Asia, the term FOMO comes in. They will all think there is something happening in this country which they don't want to miss out on, right? Main investment case for India: demographics, physical infrastructure, digital public infrastructure, the soft aspects like mood music, and finally the FOMO created by India's economic performance in the last 10-15 years. If we do things right and do the right things, the next 2 decades, 3 decades is meant to be India's decades. It's for us to use or lose.
India's M&A movement was the theme for the first panel discussion.
A is, how do you see the M&A landscape in India? And B is, companies have a choice. And what do you think and how do you think are they exercising these choices in the current circumstances?
Indian M&A continues to be extremely robust at this point of time, driven out of all of the factors on macro, stability, the kind of, someone spoke about the per capita consumption going up. The way I see M&A taking a step back is we as bankers or in this world, we are solving for a rich man problem. Okay. And that has implications as the country evolves, as the equity capital markets of the country evolve. Today, India, probably market cap of India would be close to $5 trillion on the public side of things. On the private side of things, it's $1 trillion. Every country has seen this evolution as the market cap and the equity capital market cap of this country or any country evolves from 5 to 15 to 20. The M&A volume in that market evolves at a higher pace. And the reason for that is that you are solving the rich man's problem beyond the basic needs of aspirations, growth, and that's where the trigger or the propensity of that growth only kind of doubles or triples from there. What we've seen over the last 10 years, there have been 3 broad themes which has been playing in context of India. When I joined Rothschild back in 2012-13 as a kind of an individual from XLRI, I think the first theme which we've seen is the capital markets in India has deepened to a tremendous extent. When we came in, at that point of time, private equity was a world which was small, not as deep. Subsequent to that, private equity is expanded both in terms of traditional private equity, alternate asset classes, credit funds. All of that expansion across that particular pocket of capital has happened. And why has that happened? Because any financial sponsor looks at, before entry, looks at its exit. They need to have the confidence of an exit after a particular point of time. And that is what is turning back to the equity capital markets of India. The deepening of the markets in India has resulted into them to get the confidence in their exits. Okay. So over the last 5 to 7 years, you would have seen, if one does an analysis of the IPO markets in India, I would say majority of the proportion of the companies coming to IPO in context of India has been private equity invested companies. People kind of capitalizing or recycling capital has been financial sponsors. So financial sponsor has been one of the biggest pillars in context of M&A volumes and fundraisers in India. And I see that only kind of going deeper, stronger, better. And this is also kind of driven out of multiple kind of global precedents. The second piece really is on the debt capital side of things, the bond markets have really deepened, both in context of Indian pockets of capital. Historically, long dated infrastructure, all of the projects were all financed by debt or banks. And in addition to that, the foreign markets have opened up with a lot of growth on the broader Indian economy. The foreign pockets of capital have been very comfortable taking off Indian paper. And this has opened up multiple innovative structures around offshore bonds, ESG, social infra, all of those pieces. So that's the other piece. Again, the deepening of the markets on the bond side of things, that's also happened. And the third piece is really M&As and fundraisers require limited uncertainties and risk, and people who take that risk-taking capabilities. And that is what has happened across sectors. Risk mitigations have happened. Whether you pick up the regulators or the government coming up with stable regulatory policies which over a period of time have evolved. Look, every sector requires an evolution, but it takes a period of time and then there is certainty on that particular piece. So all three of them has worked very well, and my belief is that the platform is extremely strong in some of these aspects, will continue to grow from here.
Kapish, in your business, again, I see that in the financial services, there's a lot of consolidation or a desire for consolidation happening. A lot of NBFCs are going in for listing. A lot of them are. And the other part is that even from a fund perspective, there are a lot of recent RBI initiatives where the funding for some of these companies is mostly now being sought as bonds, and overseas funding is what they're basically seeking. So my first question to you is, do you see a consolidation with many of these companies going for banking license, etc.? Do you see a consolidation in the financial services space as well?
India actually need a lot of consolidation in the banking and financial services space. Given that SBI being the largest bank in the country, it still doesn't fall in the top bracket. It does says a lot about the need for consolidation, because as you consolidate, you get scale, you get size, and then you're able to offer yourselves in a better way from price economics perspective as well. So that's something which is definitely needed. India is also hugely underpenetrated. In spite of we seeing that the credit market has grown and what you mentioned that 30% is still occupied by financial services, even then India is hugely underpenetrated. So as you expand and as you consolidate, you're then able to expand yourself into the hinterlands in the entire geographic space as well, to then offer yourselves in a more holistic manner. So consolidation is definitely needed. If I more particularly talk about NBFCs, NBFCs are far and wide. There are a whole lot of NBFCs which exist in this country, and they really struggle a lot with regard to their size. And this is one space where you need consolidation, because that's the only way you can then enable yourselves to be more resilient to various kinds of economic challenges that can come in, including geopolitical challenges as well. Because at size and scale, you go higher up on the scale as well. You become a upper layer or top layer NBFCs, which then gets far more benefits, both from a regulatory coverage perspective and also from the regulator as well.
My question to you is that how do you see the consolidation happening in the space? How do you see M&A happening in this space? How do you grapple with this situation where, when you talk about capital allocation, capital allocation is something, is always going to be a challenge, because do you invest in the traditional way, in the way in which you have traditionally invested, or do you invest in the new space or the emerging sector in the media industry? How do you invest capital? How do you look at the M&A space? How do you look at consolidation in this industry?
So let's understand the fabric of media industry as such. Unlike the print media, the electronic media, they all are in different phases of their life. And unfortunately, this cannot be an industry which can boast of a 200-year legacy. Like Prashant, but here we have been evolving, and how if I take you back to not even decades, just 7-8 years back, it was a time when actually digitization or digital revolution had started. Jio was just rolling out, and YouTube, Google was all becoming the giant that they were. At that time, TV was the most important entertainment avenue or the news avenue for all of us. So it was either the newspaper in the morning or TV throughout the day. And that was what was the avenue where everybody was consuming their entertainment or news quota. Now, what really started happening thereafter was Daily Hunt or Google started capturing the way news used to be consumed. People started watching more and more content on, say, a Netflix or even YouTube. So
at their own time.
At their own time. So the traditional media or the TVs, what we generally refer to, had started seeing a decline. And that's where the industry fabric started changing. What did this mean for the players? The traditional players now suddenly had new competition and competition from sources which were not there as a part of their industry per se. So it was a classic case where a TV player, an entertainment player, was suddenly competing with a tech giant like Google.
YouTube.
Or YouTube, yeah. And Meta and Google have become the bigger competition for the traditional entertainment or news industry per se. So this really has resulted into kind of a shake-up in the industry where the so-called Big Four were no longer the Big Four of the media entertainment industry, and even the news business was seeing a shift, and the struggle was that distributors were becoming more prominent than the manufacturers. And the manufacturers here are the content companies, the news companies, while distributors were the pipes or the aggregators. So this is a situation where the industry is seeing a lot of disruption. It's growing, but the established players are facing a challenge. But obvious that this will result into a lot of shake-up in the industry, and any shake-up leads to an M&A activity. So, unlike players who saw the future or players who took aggressive bets on the future, allocated their capital on the growth side rather than on the traditional parameters of returns on equity, etc. They are the players who actually have now today can say are on a better footing and are on a growth path rather than the classical model of importance on the return on equity. So that's how the fabric of industry has changed. The M&A activities follow wherever there is disruption, and M&A has been an important part of media and entertainment industry as we see today. The second part of your question about the capital allocation. In fact, I represent a company where we have been very heavy on digital movement. We have actually led the entire digital innovation and digital migration, not only in the media industry, but overall, in fact, Reliance Group as such has been the leader of this change in the day-to-day life of an individual. So we saw it early on. In fact, 7-8 years back when TV was giving us very good returns. TV was the most profitable part of our business, and digital was a very small portion of the total revenue. We started investing very heavily on digital part of the business. And the bets that we took that time were obviously not fitting into the classical financial role model of the returns. But this was a growth capital that we decided about.
Hershey's is obviously a global brand, and we have all been consuming it for years. What are your primary strategic goals that drives Hershey's investment strategy?
So from a Hershey perspective, it's great to see everyone loves chocolates, right? So I don't think there's be anybody in the room who wouldn't be saying, I don't like chocolates. So for us, it's quite simple. What we do is to have a buy market, where to play and how to win. Okay, so which is making things very easy, very sharp, which clearly defines all our actions around growth or where to expand and how profitability plays in and all of these things. And this is different by market and by geography and all the other consumer nuances which we will talk about a little bit more. And today what's happened in the FMCG landscape is it's not so much about this or that. everyone is moving more towards an and philosophy, right? So you want to grow, you want to expand, you want to kind of capture, bring in new products, you want to expand into adjacencies, you want to be profitable. So it's become a bit of, the and philosophy. And I think pretty much most of the FMCG players are in that space. And gone are the days maybe when you say it's only top line and I will just go behind valuation and kind of drive top line. So it's all about sustainable, profitable growth that really keeps the firm running for a long period of time. We will be definitely focusing on the core because that's bread and butter. Which is chocolates. But we also have a lot of adjacency products. If you are looking at the Hershey portfolio, you have cocoa-based products, milkshakes, there's spreads, there's so on and so forth, right? So all of these products are also going to be part of our portfolio offering as a multi-category play. Right, and we kind of look at investments, whether it's new innovations or new business models, to basically cater to new evolving consumer needs, and make sure that we are having something viable that can play in that space. So that's how we think about the whole business model around not just India, but any market.
Pratik, in hindsight, we can always look back and say, hey, listen, I did a good deal. But at the time when you're doing the deal, it's very difficult because you can see a lot of risks, okay, which can discourage you from going in for that transaction. So could you share maybe taking an example of a particular acquisition or an investment or divestment as you may consider, where you can share what thought happened at that point in time, why was it right, and it only proved to be right over a period of time?
While I mentioned we have done 20 transactions, Rajeev, over last 6 years as a team, I have, we have looked at almost 600 to 700 transactions we have evaluated over last 6 years.
That's a very important point.
And I personally have evaluated roughly around 200 to 250 transactions. So the important point is, you need to be patient, and there will be opportunities in the market, and not every opportunity you have to act upon. Okay, our underwriting is very, very strong, and thanks to our DNA from the Kotak group, we are very, very cautious of what we are investing into. And of course, there is a lot of thought process that goes around before we invest. Let me take example of maybe 1 or 2 transactions that we have done. This is a buyout transaction and very relevant for the current topic because it's actually an M&A transaction that we have done. What happened was there's this company, there's a company which used to own a road asset, and the company had received a contract from the government to construct a road in the state of Telangana, a 200 odd kilometers road. And in lieu of the construction, the company was given the right to collect tolls for a period of some 15-20 years. Now the problem what happened was that after construction, as usual in India, what happens is there was a significant construction delays. And when the road was being constructed, there was X number of traffic that was estimated on the road. And when the road actually got built up, the traffic was significantly lower than what was estimated. If the traffic is lower, you will have lower tolling revenue. If the tolling revenue is lower, you will have lower the profits. And of course, you will not be able to sustain the debt which was taken for the company. Now, the debt was roughly around 1,500 odd crores on this asset. It was unsustainable. It was an NPA for quite some time. That's where we entered the picture. It took us almost 1 year to convince the lenders along with the management that, you need to exit the asset and we are willing to offer you this price, because lenders were sitting, nothing was happening, the road was stuck, and beyond a point of time, it's kind of a vicious circle at the end of the day. After 1 year, the lenders agreed to this, and we gave them an exit. We paid roughly around 800 odd crores on single check, full exit, took control of the company, took control of the management. Over last 3 years, we completed the role. Trust me, I have 4 degrees in finance, CA, CS. I have never dreamt of me constructing a bridge or constructing a service road, but that's the part and parcel of an M&A transaction because you need to own it, you need to be responsible for it. Yes, so 3 years, we have completed the construction. We have implemented a slew of measures to improve the revenue, overhauled a significant part of the road, received the final construction certificate from the government, and we put the asset on the block and keeping our fingers crossed to make some good money on it.
The second panel discussion saw experts discuss India's role in the shifting global economy.
What is that you think has changed in last 3 to 4 years that is leading to a situation where we are getting more confident about our retail participation, domestic flows, more people interested in markets? What's going on here?
For retail participation, actually, it's a mix of both today. Our markets have given positive returns for 8 of the last 9 years. Okay, and we have 10 crore retail participants today in the market. 10 crore, not 10 crore accounts, but 10 crore individuals with PANs, actually. You may, take out maybe around 1,000 mutual fund PANs, some proprietorship firms. All together told will be some 10, 20,000, but you still get 10 crores because the number is around 10.5 crores at the moment. So background factors as economists, of course, for us are, we've had lower rates of return on other assets. So household savings have tended to move towards non-fixed income based assets. And at some point, it was also visible for banks where deposit growth, we saw the deposit growth numbers. But in general, that's been happening. That's been the push. But from the pull side, you've had this impact of DPI. India is one country that has the kind of DPI that pretty much no other country puts out. I'm talking about digital public infrastructure. Indians today can transact with each other costlessly, easily, pretty much better than any other country in the world. So that happens. So for the common individual, this translates into very cheap mobile phones, excellent connectivity, and through Aadhaar and the digital stack, a way in which the system recognizes you. And that recognition then can be translated into opening bank accounts, trading accounts, and what have you. It's not just trading accounts. It happens around 10 years back or 5 years back with bank accounts. So the number of people who are covered under bank accounts also has shot up, but it just happened a few years before this. And then you had the grudge and envy part. So you see bank returns in real terms, not really very much to talk, take home about. And you have market returns which have done fairly well. India today is the world's 4th largest market, and we can speak about foreign investors later. But for Indian households, the part of their financial savings that went into shares and debentures was always, very low. And that number is starting to sort of pick up. And then when you see performance, which is what leads me to that point, that out of the last 9 years, 8 years have seen positive returns, you've seen significant move up. And which is why traditionally, Maharashtra, Gujarat were the 2 states which had investors. Frankly, lots of investors came from only these 2 states. But today, you have a lot coming from Uttar Pradesh, a lot coming from Rajasthan, West Bengal. So these 5 states today have 50% of all our investors. I could go on, but that's the sort of point. And they have put in, either directly or indirectly, Indian households, enough capital that Indian markets, despite the recent correction of around 7-8%, have returned very good. In fact, 20-year CAGR is 13%. We don't see any other markets with that kind of returns. So this is the kind of Indian story that's sort of coming up.
The sell-off by FIs, of course, it had some impact, but probably had this happened 20 years back, the impact would have been much bigger. So how do you see that in the context of like a lot of these things, great CAGR in terms of returns investors have made, but it also leads to a situation where valuations become a concern in some pockets at least. FI flows, they are still not very certain what will happen next 3 to 6 months. All that, like what is that you see, Anupam, in terms of like what could happen in next 3 to 5 years? Of course, market fluctuations will continue on a weekly, daily or monthly basis, but how do you see this panning out in next 3 to 5 years?
So FIs were actually the first discoverers of Indian stocks. So their participation started much earlier than what Indian retail started. And thanks to the hard work of mutual fund industry and to some extent insurance industry, retail has still indirect exposure to stocks. Till 2001-2, we had very little a number of companies that we call really world-class. Right? And if you want to really grow, really want to do big things, you need world-class enterprises, right? With deep managerial capability, etc. During this time, we also kind of improved our governance structure. So a lot of digital acceptance, etc., adoption, technology, a lot of things were sorted out in terms of policy, etc. That gave a lot of confidence. And at the same time, we improved our financial capability. So to grow, you need capital, right? So banking system was in mess. That in last 10 years, 10, 12 years, we have kind of cleaned up. We never had risk capital that we created, either through stock market, private equity. Almost every global big brand of private equity is now present in India. If you have a good business idea, you will get funding, right? And also remember, 99% of these will fail, but they will still create a big growth engine, right? Nowadays, so my company's headquarters is in Bangalore, and they prefer to hire failed entrepreneurs. Failed young entrepreneurs, that is like our target audience to hire. Because these guys are like multitasker, they can take lot, they can think differently, etc. So because of all this, the time when we were going through a lot of crisis, at the same time, at the bottom, at the micro level, we were improving our capability, our capacity. And of course, infrastructure happened, etc., etc., etc. And that is the result that suddenly this boom happened. That post-COVID, the assumptions were that India will collapse. So this whole rise is not out of course, greed and psychological urge to speculate, right? Every human wants to speculate. But also it came out of a very big positive shock that post-COVID, India didn't collapse. And that was the whole idea, right? Because we can't survive, because we are so pathetic, we poor. So that's the whole thing. And now companies are really confident. They are doing good things. So what can happen in next 3-5 years? No one knows. But what we believe is the process. That if you have a growing economy, and if you are getting things right in terms of capability, capacity, and confidence, what I call is 3 C's. You are building up capacity, you are building up capability, and you are good in confidence, you are good to go.
What do you think is the key challenge and which we need to address on a very urgent basis?
The challenge for us is to move away from being a cost competitive, labor competitive economy to be a truly value-added economy. So far, we were talking about China +1 manufacturing, where the Apple vendors would import components, they would assemble it, ship it out of India, we would do 1% value addition. That's not large, right? That would look great in terms of the quantum of exports, but when you go deeper, the value addition is very small. So the challenge is, how do we increase this quantum of value addition, whether it is tech or manufacturing? And for that, what is important is availability of skilled labor, investment of dollars in R&D, both by the public and private sector. To me, when you look at all factors of productivity, going back to my economics professor, land, labor, capital, and entrepreneurship, to me, labor is the most critical thing that India needs to invest in. We already have the world's largest working age population, right? Almost 60% of our population is in the working age. But what is our labor force participation? Only 50%, much below people. What is our female labor force participation? Only 26%. What is our productive labor force participation? Even lower. So question is, there's enough opportunity, enough jobs. How do I increase the skill set to make this labor force more employable and in turn attract high quality tech, high quality manufacturing in India? To me, that's the biggest challenge. And if we solve that, becoming forget about a 6 trillion economy, a 60 trillion economy will not be very difficult.
Sojan, of course, India is seeing a lot of domestic investment in markets, but still will be a country where we'll need a lot of foreign investment, both direct and portfolio investment, most welcome. Considering what is happening globally and whether we call it volatility or maybe the factors which are unpredictable, uncontrollable, what are the policies, like what is that we can do and which is a part of controllable factors which we can address, which we can probably do something about? Of course, what will happen to the world will happen. We can't control that, a lot of these things. But in your view, what is that we can address? And what is that you think is a controllable variable, maybe more than one, more than two, What is that we should be doing about that?
I think there are a few key things which is very important to do. The first thing should be the regulatory framework. Because if you talk to any foreign investor of any kind, the biggest grudge you will hear, it's very difficult to get things done in India. Obviously, we have seen in the recent past quite a bit of initiative to improve the clearances and actually at the ground level things. But I think that is one, the red tapes is, and also some of the regulations, particularly in the context of ownership, labor, all those things. So that is one set, I think, which is very important. The second set, which obviously this panel has already touched upon, is the quality of education and training. Because this is something when you are investing in India, so we can say that we have the largest pool of engineers, we have perhaps the largest pool of MBAs, but even when we are hiring, we see that a lot of people who are coming, joining the workforce, we have to invest in them for a year, for 2 years, to make them learn even to do the basic things like matching the cash flow. So there is a gulf between the on-job skill required and what we are teaching, and particularly for this forum, it's definitely there has been improvement over times. The collaboration between industry and the academic institutions, particularly the business schools, have improved. But having said that, there is still a very large gap, and I think that needs bridging. So I will say that this human resources and the regulation, perhaps if we get our act better here, that will be one of the biggest way to attract more foreign money into India.
What is that you think is a challenge we need to address in terms of inflation? And how do we manage that in terms of not impacting the growth which we are having? Maybe 7%, but 8% could be better. But again, it comes with its own pitfalls, its own challenges. How do you see that? How do you think we should address that?
Many of us would recall here about a decade and a half back, 8% GDP growth and 5% inflation was expected or set to be like the classic combination. Today, it's a very unrealistic growth number and an unacceptable inflation number to sort of go with. That's because things have changed dramatically. I think if you look at the Indian economy, and I've been speaking about this for the last 3 weeks using this anecdote specifically, is because a lot of animals have been associated with how the economy is now looking like. It used to be elephants at some point in time. The central bank governor, referred to us as horses. But I think it's also important to, I'd say relevant if we look at us from the perspective of being a camel. A camel is strong, it's resilient, and it's adaptive to extreme harsh environments. Characteristics that even the Indian economy has exhibited over the last 3 to 4 years. We've been one of the very few economies who've actually come out of the COVID pandemic strong, agile, and with relatively less fiscal support, so to speak. And that's happened because we've learned from our past. Having learned from our past, I think that one of the best things the government now did is that it was absolutely prudent in terms of its use of fiscal policies. Wherever it was used very judiciously. Now coming to the growth situation, honestly, we need to understand what's been driving growth over the last 3 to 4 years. It's largely been investments per se. Consumption continues to be a laggard because of the nature of fiscal policy infusion that we've seen. So it's been intentional in some ways to ensure that investment is what is leading, and investment tends to bring in durable growth. And when growth is driven by investments, when it's driven by productivity gains that are expected down the line, when it's driven by policy and process reforms, it's not going to speed up significantly. So an expectation of 8 and 9% sustainable growth should honestly not be very rational given this background. And therefore, although this might seem ironical that people are talking about optimism in India, but nobody is projecting growth at 8 and 9%. This is exactly the reason. Growth is supposed to be durable in the range of 6.5 to 7 and relatively stable and steady. I think that's the way to really look at medium term. Coming to inflation, it's again pretty ironical that I said consumption has been a laggard, but inflation is picking up. Now, in that really lies the inflation story. In that lies the constraint that the government is really, or the RBI is really facing. Because let's just look at what was the recent inflation number. It was 5.5% in September. You take out food, and non-food inflation was about 3%. Food inflation was 9%. Let me again give you another number. Look at the last 12 months. Food inflation has been at 8%. Non-food inflation has been below 3%. So what can the RBI alone do by raising interest rates? And that makes inflation control in India a very unique problem and which requires unique solutions. Unlike the US, where Fed rate hikes percolate and then therefore can bring down inflation, in India, an RBI rate hike cannot bring down inflation. It requires fiscal policy to intervene. How has fiscal policy really intervened? Is by, for instance, when food prices go up, releasing of food stocks, coming in with export bans, facilitating imports, say, of pulses and all of these commodities. That is what has helped in the short term. Eventually, the goal of the central bank, since we are now an inflation targeting central bank, is to bring down consumer price inflation from, say, 5.5 or so where it is today to 4% and ensure that it stays there. So that's exactly one of the reasons why the RBI is quite wary of beginning to cut interest rates, because it needs to be sure that inflation is going to come down to 4% and stay there.
In whatever we do, but we also have a global role. Like Tirthankar mentioned, we are a 4th largest market. We are 5th largest economy in the world. So how do we contribute in global economic stability? Our role is much larger versus how it was 30 years back. So Momita, how do you see this?
The wheels of change are already turning, and we have got quite a few things in place. And I personally believe the most important ingredient for success is a structure. If you put things in structure, then we do get success. Why am I saying this? Because if you look at the past few years, our institutions, some of our institutions have done very well. Particularly the RBI has been performing much well than the other central banks. Why do I say so? What are the numbers we are looking at? You take the case of currency. India has been performing, having the least volatility among the emerging market currencies, among the emerging markets. So first half of 2024, the INR has depreciated around 1%, whereas the other emerging markets have had a depreciation of 4 to 10%. We are sitting at a foreign exchange reserves, which is the 5th highest in the world. Of course, we are comparing with China, who is like 5x times us, but we are still the 5th largest holder of foreign exchange. We are not talking about the 2 elephants in the room, which is the fiscal deficit and the current account deficit, which we have done for the past 10 years. Because we are doing well in kind of our export of goods and export of services. So the RBI, the proactive management of inflation by the RBI has helped in navigating the current situation, the current macroeconomic situation. I agree with Dipti that we are trying to tame inflation, which is very difficult to tame, bring it down to a 4% number, and the RBI is struggling with it. And we cannot have enough of discussions around it. But some things RBI has done very well, which is keep putting us in the global map. People everywhere we talk about, every report I'm writing, we are writing India as an investment destination. Why are we writing it? Some things have gone right. And I believe here the role of the RBI has been quite exceptional in navigating us through turbulent times.
XLRI presents Gnosis 2425. Media partner CNBC TV18.